Donald J. Trump just proposed 50-year mortgages in the United States. Not 35, not 40, 50 freaking years. That means you'd be paying off your mortgage if you're 40 years old when you're 90. That's wild. And here's what nobody is talking about right now. Canadian regulators are actually watching this very closely because if this goes through in the US, there's a remote, even just a tiny little possibility that CMHC could absolutely follow suit. In the next 20 minutes, I'm going to break down exactly who wins, who loses, why this might be the worst or the best thing to happen in North American real estate in decades. Now, stick with me because by the end of this video, you'll understand something that 99% of Canadians I don't think even know is coming. Let's get right into it. First, let me show you exactly what happened because this dropped like a bomb over the weekend. On Saturday, November 8th, Trump posted an image on Truth Social comparing himself to Franklin D. Roosevelt above FDR's picture, 30-year mortgage. Above Trump's picture, it was 50-year mortgage. Within hours, the Federal Housing Finance Agency, holy this is a lot, Director Bill Pulte confirmed it on X, formerly Twitter. With thanks to President Trump, we are indeed working on the 50-year mortgage, a complete game changer. Now, here's the pitch. Lower monthly payments by stretching the loan over 50 years instead of 30 years. Let me give you the actual numbers here because these come directly from Fannie Mae's mortgage calculator. Fannie Mae in the United States, in case you're Canadian, just so you understand the concept. A 30-year mortgage right now, based on a 6.575% interest rate with 20% down, is $2,038 for principal and interest. 40 years, $1,891, and 50 years, $1,822. That's about a $216 per month going from 30 years to 50 years, which is about $2,600 per year. That sounds great, right? Now, here's what they're not telling you. On that $400,000 home over 30 years at 6.575%, you'd pay approximately $414,000 in interest alone. Over 50 years, you'd pay approximately $775,000 of interest. That's an extra $361,000 in interest payments for the privilege of saving $216 per month. Let me repeat that. You'd pay an additional $361,000 to save $316 per month. Now, before we go any further, there is a massive legal problem with this plan that nobody's actually talking about. And here's where it gets interesting and why this might not actually happen. After the 2008 financial crisis, if you can recall that disaster, Congress passed what they called the Dodd-Frank Act. Look this up. This law created something called a qualified mortgage or QM rule. Under the QM rules, mortgages cannot exceed 30 years, period. For Trump's 50-year mortgage to become mainstream, Congress would have to repeal or amend the Dodd-Frank rule, which is a massive change in the marketplace. Now, if you're Canadian, you're listening to me talk about all this stuff, it'll make more sense in the coming minutes. So stick with me, bear with me here. Could lenders offer 50-year mortgages as what they call non-qualified loans? Technically, yes, but that comes with higher interest rates, sometimes 1% to 2% higher. It's kind of like in Canada, we have alternative lenders. This would have to fit under the alternative lending bucket. So that $1,822 payment under a higher rate would actually end up being even a higher payment. So there is no benefit at that point at all. So my take on this is that this proposal is either potentially brilliant theater, as Trump usually has, or he genuinely believes he can get this amended, which given Trump's relationship with Congress right now, I'm betting on number one, the theater piece and the chances of this not actually going through. But let's assume for a moment it goes through. Let's talk about who would benefit. Again, this is America in the United States. It has to bring back home to Canada. So continue with me. I ran the numbers on who wins and loses in the States, and I was thinking about this hypothetically from a Canadian perspective as well. Now, let me be crystal clear about this. I am not going to play middle ground. This is either catastrophic or it's freaking genius. And let's get right into it. The obvious winners here are banks and companies that lend out loans. Banks make money on interest, and a 50-year mortgage means they collect interest for potentially 20 extra years. On that $400,000 loan, remember the bank collects $361,000 in interest in 50 years versus 30 years. Multiply that across millions of loans and mortgages. You're talking trillions of dollars flowing into financial institutions. Um, Perfectly said by Marjorie Taylor Greene. It will ultimately reward the banks, the mortgage lenders, and home builders, while people pay far more in interest over time and die before they pay off their home, which is something I want to key into. When even Trump's allies are calling this a giveaway to the banks, you know that something's a little bit wrong here. The developers and home builders will benefit because if there's more borrowers qualifying, there's more homes sold, which is simple math. And that could be a good thing from a perspective of supply. When that payment goes down by 200 $300, suddenly an extra 5% to 10% potential buyers can qualify for a mortgage. That's millions of additional customers for home builders. And the real estate agents, obviously, they want to see this for the most part, right? More transactions, more commissions, pretty straightforward. In the US breakdown of how this would work, who would actually lose? Ironically, the first time home buyer. This is marketed as helping buyers afford homes, but the brutal truth is it doesn't really address the real problem. The real problem in the US, as just like it is in Canada, is not necessarily just affordability, it's actually supply. America, just like Canada, has a shortage of homes, millions. In the US, it's roughly 4 to 7 million homes. And in Canada, it's hundreds of thousands and millions over the course of the next 7 years. You will never solve a supply crisis by making it easier just to borrow money. All you're going to do eventually is drive up prices, assuming everyone can qualify for this. If you think about it reasonably, if you bring in 10% more borrowers to qualify for mortgages, what happens with price points of properties? This is what happened during COVID. Cost of money went down. People could borrow more money. They went up in terms of qualification. Because again, if you don't build more homes, you just pumped up more demand on a supply constrained market that's not going to help. So that first $200 that's going to save first time home buyer is going to bring the price of a home up by $30,000, and then they've just lost out in the long run. Here's the thing that a lot of people don't understand about mortgages. Your home equity is one of the primary wealth building tools for middle class families. With a 30-year mortgage over 10 years, you can actually build meaningful equity. With a 50-year mortgage over 10 years, you barely made a dent. The thing is, on a 6.5% mortgage on a $400,000 loan, after 10 years on a 30-year mortgage, you'd owe approximately 310. You would have paid off 90 grand. After 10 years on a 50-year mortgage, you'd owe approximately 360,000, which means you would have only paid off $40,000. That's $50,000 less equity. If the home appreciated to 500,000, yes, you'd have more equity of 190 versus 140, and that is you have to consider that. But it is a serious concern here too. I mean, we do know inflation will occur over time, but the loan amount will continue to stay high. Now, there was a lead analyst from a United States publication called Housing Wire who said subsidizing more demand from 30 years to 50 years prevents the market from balancing itself out through a slowing home price growth and wage increases. And he's kind of right. The housing market needs corrections. They need corrections to be able to remain healthy. That's what we're going through in Canada right now. When prices outpace wages, eventually the market will adjust. Either prices come down or wages go up or both. And we're seeing that, which says 50-year mortgages, they might delay that correction by artificially propping up the demand. But it's like giving painkillers to somebody who broke their freaking leg. You're treating the symptom and not the problem. My verdict on this US proposal is that this is probably not the ideal policy to fix the problems. This is probably a terrible policy, in fact, disguised as affordability assistance. It solves nothing and could create a generation of debt slaves while enriching more banks. And one of the biggest reasons for that is because even if it is a good idea for some people, most people are not financially savvy, and so they wouldn't use it in the right way. If Trump actually cared about housing affordability, he'd probably focus on removing zone restrictions to increase supply, reducing building red tape, incentivizing constructing of proper starter homes, and maybe tackling institutional investors buying up single family homes in the US like might happen in Canada. Instead, there are 50-year mortgages. Now, here's where this gets important for Canadians. This is the part that matters to you. Pay attention now. Because if you think that this can happen here, you haven't been paying attention to Canadian housing policy. And again, this isn't inherently bad. It just comes down to where it was. Let me give you some history that you might not know. Canada already had 40-year mortgages. In 2006, CMHC started insuring 40-year mortgages as a pilot program. It became permanent that same year, and they also offered 35-year terms as well. But after the 2008 financial crisis, the government they got spooked. In 2008, they cut the maximum from 40 years back to 35. In 2011, from 35 to 30. In 2012, from 30 to 25. Fast forward to December of 2024, and the government just extended amortizations back to 30 years, but only for first-time homebuyers and new builds. Now, if you see the pattern, Canada's housing policy swings like a pendulum based on the political pressure and the market conditions. Right now, Canada has the highest house prices relative to income in the G7. First time homebuyers averaging 40 years old, which is the highest ever. Extreme supply shortages in every city and massive immigration targets with unprecedented demand. The political pressure to do something about affordability is absolutely massive. So, the question, could CMHC propose 40-year mortgages or longer? Not only could they, I'd bet money that they're already discussing it internally. Here's why. Number one, political cover. If the US implements a 50-year mortgage, Canadian politicians can point south and say, hey, we're just following what they're doing. Precedent. We've had 40-year mortgages before. The framework exists. Private lenders do it. Right now, if you have 20% down on an uninsured mortgage, there are some private lenders that are offering 40-year amortizations. And on top of that, developer mortgages, CMHC is doing up to 50, 55-year amortizations already on development mortgages for multi-unit projects. And if they'll do it for developers, they'll eventually do it for consumers. Now, here's roughly where it could work in Canada. The most likely scenario is that CMHC announced the first-time homebuyers can get 40-year amortizations on insured mortgages with less than 20% down. The pitch would be helping young Canadians enter the housing market. And the reality would be another subsidy for banks and a band-aid for a bullet wound, even though I personally, to a degree, think there could be some merits of having this to get into the housing market as opposed to alternatives. The banks would win. Obviously, Canadian banks are some of the most profitable already in the world because Canadians are obsessed with the relationships with their banks, among other things. This would be a windfall. CMHC would get crazy money as well. They get more insurance premiums and the revenue would go up. The real estate industry would benefit too. Realtors, developers, they'd benefit from increased transaction volume. You can't blame them, but this is just the truth. Who could lose? Well, eventually, first time homebuyers could lose again, which is the same problem as the US if you have not increased supply. So prices just absorb the new home buying power. TD Economics ran the numbers on a recent survey of the 30-year amortization expansion. They found it increased borrowing power by approximately 9%, which is awesome. That's good. The downside being it can just get eaten up by higher home prices. Now, that's not been the case yet, and we have seen more first-time buyers enter the market this year than I had in previous years. Just something to consider. The thing to look out for is that this would actually negatively affect Canadian taxpayers. Payers. CMHC is backstopped by Canadian taxpayers payers. When people default on CMHC insured loans, we pay for it, which longer amortizations, higher default risk, and that risk is going to flow to taxpayers. What about long-term economic health here? Like the uncomfortable truth is that Canada is dangerously dependent on real estate. We don't manufacture as much anymore. Our resource sector is struggling. What do we have is real estate, and our government isn't even helping us create more housing. I mean, that's the problem here. The supply issue. We say it's not, but it really is. We're building homes that people don't want to buy, and they're not buying them. And they're sitting there unable to buy because they can't qualify for them. So this fixes the issue on one hand, but the resolution, we're not resolving it because a resolution would require some proper planning and some supply. My verdict would be there are merits of offering up to a 40-year mortgage in Canada. Ultimately, I think it would probably be a mistake, partially because I don't think it would be rolled out in the right way to the right people. I think it would cost too much, and I think the average Canadian would not be educated on how to get out of it. Truth is, the political incentives to make this happen, though, are strong. None of the politicians want to be seen as not helping young home buyers, even if the help is actually harmful. However, there is an important consideration here, and this is where longer amortizations could make sense. if and only if they're paired with the following. One, massive upzoning and density increases. That would have to be part of this plan. Number two, streamlined building permits. Come on, people. Three, the removal of all of these DCCs or development charges that add up to $100,000 to the cost of your new home. That's a serious culprit here. And number four, get rid of all the restrictions on investment purchases. Without these supply side reforms, longer amortizations are just going to end up being gas in the fire. So it could be good, but without fixing the problem, it's useless. So what do you actually do with this information? Here's what this means to you and your personal decision. Let's talk about exactly what you should do right now, because doing nothing is actually also a decision that you're making. Now, if you're buying in the next 6 months, I would highly not recommend for the rules to change to look into this. And the reason for that is because it's not certain. Listen, the government banking regulators said, this is OSFI, said that they like what they're seeing with the new system, but that doesn't mean that they're definitely replacing the current stress test. They could easily keep it entirely, which is what everyone's assuming. They could keep both systems running in conjunction. You'd have to pass both the LTI and the stress test, which would be even worse. They could modify the current stress test and keep the new rule as a backup plan, or they could do nothing at all. And we don't know which one they're going to go with and how they're going to implement this, just that something will be implemented. A second reason is that you might not benefit from the rule changes. And even if they do replace the current system, you actually might not qualify for more money. If you need to borrow 4.5 times your income, you're kind of gambling that your chosen bank has that quota available if they use that for qualification, and that rates don't rise before you close on your property. Prices don't jump and eat up that extra borrowing power. The mention here is not necessarily to scare you into making a move now. It's to be conscious, because if you didn't know in advance, then you can get mad at me and say, I didn't tell you, but now you can't. The third reason is that every month you wait is a month that you could obviously, if you're trying to be a homeowner, you could be building equity instead of paying rent, or at least locking in to figure out what the options are, or figuring out what your qualification is, which basically means know where you stand today so that you can determine what you want to do for later. If you qualify under today's rules and you feel comfortable with where things are at, and you want to buy a piece of real estate because you're going to hold on to it for a long period of time anyways, then it's probably a decent time to find out where you're at right now. And if you're not sure where you stand, you want to do one of two things. You want to calculate where you stand, which is 4.5 times your income. The other option is you want to look at the current stress test, which is to calculate the monthly payment at the current rate. So let's say rates are 4%. You want to calculate a 6% and see if you can afford that at 39% of your gross income. Now, if you don't know how to do that, if you look at the link below, follow me on Instagram at the Mortgage Pug, type in qualify, and I will send you the calculator to determine what you qualify for or help you out if we need some help. Now, the new rule is really simple. Take your household income, multiply it by 4.5 times. That's your maximum mortgage. Now, the best thing you can do here is just compare the two options and figure out where you stand. And basically, if you're close, then you could probably do whatever you want. If one is much higher than the other, then you know where the constraint is in making a decision. Now, if you have a renewal coming up in the next 6 to 12 months, the good news is right now, in the next 6 months, it probably doesn't affect you. Renewals, staying with your existing bank, it doesn't, you don't need to requalify. You're renewing existing debt and you're not taking on a new debt. But the time it does matter is if you are refinancing to pull out equity, restructure it, reduce your payments, change the amortization, or move, typically speaking, to another lender. But there is that one reminder, last one, that if you're planning to switch lenders, as of November 21st, 2024, the government already removed the stress test for current switches. So if you're moving from one mortgage company to another mortgage company, as long as you qualify, which is the key to all this stuff because not everybody qualifies, then it should make it relatively easy. Honestly, the best thing you could do right now is really simple. Figure out where you stand and look at what your goals are right now. So, when we actually find out when this is changing is the question, because I know some of you are thinking, should I just wait and see what's going on? The government actually said that their timeline is anywhere between January 2026 to spring 2026, which basically means we're probably looking at February or March for their assessment, with the final decision being somewhere between April through June, which is roughly about 3 to 6 months from today, with the four possible outcomes: replacing the stress test, keeping both systems, modifying the current stress test, or doing nothing at all. And from the lenders that we're talking to right now, what we're hearing is they wouldn't spend this much effort just to scrap it. So chances are something is going to change. And the regulators basically said exactly this. We like what we're seeing. It's working as intended. My best guess is that they'll at least change or modify the current test, if not eliminate it entirely. But my guess is not certain. And honestly, my biggest piece of feedback is we wait to watch what happens in February and March of 2026 from OSFI to see exactly what they end up doing. What it means for you, bring it all home. If you're a buyer, if you can qualify today, find out where you qualify. Look at, lock in a pre-approval, get your numbers fully underwritten, because at least you know where you stand. If you're selling, it doesn't really affect you. The price of your property is subject to the demand of the property that you're looking at. And for everybody that's just generally curious, take your income at your gross that you think would be qualified, times that by 4.5 times percent of your income, and you'll find out what you could qualify for if these rules change. The bottom line is that Canada's mortgage rules might change by spring of 2026. And if they do, some people will benefit, mostly high earners in more affordable markets, and others will face some tighter limits. But right now, at today's rates, neither the stress test nor the 4.5x is really stopping the average person. Again, 88% of Canadians are not going to go above that anyways, so you're probably going to be doing just fine. I'm going to be watching to see what happens over the course of the next few weeks, to see the actual rule, how it rolls out, how the banks actually approach this, and obviously make sure to report as much as I can. Now, if you want to stay ahead of what's going on in the Canadian real estate market and cut the bull crap, make sure to subscribe to the channel. And like I said before, follow me on Instagram at The Mortgage Pug, and I'll see you on the next one.